yeah, kind of go through there. So what I'm going to do first, I think we got some people still jumping in, but
I think I've got most everybody in now.
yeah. So I'm going to share my screen, and I have a few slides that I created to kind of simplify how lines of credit work. So let's start going through those. I'll share my screen. Hopefully you guys can see my screen. Yes or no, maybe so.
We see it.
Okay. Okay. So a little background on um, Jim, Christy, Shane, and myself, just for people that may be new. Jim Kindred, he is the founder of Creative Capital Strategies, which is the group that we work with primarily. And then he linked up with Michael Lush, I'd say probably about 10-ish years ago. And Michael Lush is the guy who started Replace Your Mortgage, which now is a subsidiary of a larger company called Replace Your University. But so they've worked together for quite some time. I've worked with Jim for the last probably 5 or 6 years. His daughter Christy has worked with him for about the same time. Shane's been on for a handful of years too. So we all work together as a team. We primarily handle Replace Your Mortgage clients. So people that are in that group that are practicing the first lien HELOC strategy, or some people are using a second lien HELOC. We'll kind of go through the differences in a bit, but we work with those clients primarily. Um, so a lot of what we do is life insurance related. However, we're very familiar, and I personally use myself a home equity line of credit on my house. Um, so let's kind of go into different lines of credit, how they work, the strategies that you can utilize with lines of credit, and kind of how that works. So um, most people are familiar with credit cards. Credit cards can be good. They can also be bad. Dave Ramsey, as an example, is adamantly against people using credit cards, and understandably so, because credit cards, you're essentially using other people's money or money that you may not necessarily have, which can get people into trouble, right? So, but if you use them responsibly, there's a lot of benefits to having them. Some of those benefits are getting points or cash back. As an example, I have a couple credit cards where I get 2% cash back on all my purchases. So, for the stuff that I'm spending money on already, might as well use a credit card and then just pay that credit card off at the end of the month to avoid the interest, because credit cards have very, very high interest costs if you don't pay them off. So we want to avoid that. But again, most people are aware of how they work. Um, Credit cards are good and bad. And then there's also HELOCs. So HELOC is a home equity line of credit. The most common understanding of a HELOC is someone has an existing mortgage on their house and they have equity in their house. So they go to a separate lender and they ask them if they can get a line of credit through them with the equity that they have in their house. Typically, typically, people will use that for home repairs, home upgrades, which is good. You're going into debt, but you're improving the value of your house, so that can be a good thing. Again, just like credit cards, you have to manage that debt. Any debt, whether it's credit cards, HELOCs, whatever, can get people into trouble. So you want to be careful with how you use them. Um, and then a lot of what we do primarily is we work with whole life insurance policies. So most people aren't aware that within a whole life insurance policy, you can actually have a line of credit with your cash value. So it's very similar to a HELOC as far as how it works, right? You can put money in and you can take money out. It's a liquid account. Okay. Now, the main difference between all three of these is credit cards are very fast liquidity. You can literally take your card to a store, scan it, insert it in the thing, boom, the transaction is done. Very quick and easy. HELOCs, not so quick and easy. Sometimes there's a day or two delay depending on the bank that you have. And then whole life insurance policies. If you want a loan from your policy, it's going to take 3 to 5 business days. So the transaction time differs between all three of the different products. So that's a main difference. But so let's kind of jump into each one individually and talk through that. So we'll kind of start with credit cards. But the main thing you want to understand is how the interest is calculated. So these products calculate interest daily on the outstanding balance. So any balance that you have, depending on the day, you're going to be charged an interest cost based on that balance, right? So your balance may be this much one day, the next day it may go up or it may go down. Whenever that balance changes, the way that your interest is calculated, can fluctuate how much interest you're going to end up paying. Okay, so that's something that you need to manage as well, right? So one strategy is to kind of, reduce the cost of interest with any line of credit. You can deposit surplus cash or savings into the line, right? And when you do that, it immediately reduces the principal balance. Okay, so say you have a credit card balance of $10,000 as an example. Okay, you have $2,000 sitting in a checking account, not doing anything for you. So by repositioning that $2,000 into your credit card, right, your credit card balance is going to go down from 10,000 to 8,000. So now you're going to be charged interest off of not 10, but 8,000. So it helps to reduce an interest cost by simply repositioning money into the line. Okay, so that is a beneficial thing. Now, you can do that with all three of these different products. So credit cards you can do it with, a HELOC you can do it with, and even with your cash value inside a life insurance policy, you can do it with. Okay, so they're all pretty much the same as far as how they calculate interest. Again, just to recap, you have a balance based off of whatever that balance is. That's what's going to determine how much your daily interest charge is. Okay, so let's move to this next slide. This is kind of the math on how this works. This is really simple. Don't overcomplicate it. It's just a math equation. So how daily interest works, let's use a balance of, let's say, $50,000 as an example. Okay, so again, there's three components to how this works. There's a balance, there's an interest rate, and that determines the daily charge of interest. Okay, so let's use 50,000. So say you have a $50,000 balance on whatever, doesn't matter, and your interest rate is 8%. This is how the calculation works. Okay, they take the balance, so that would be $50,000, multiply it by the interest rate. Okay, and then you divide it by 365, which is the amount of days in a year. And that gives you your daily cost. Okay. So when you do that, and feel free to bring up a calculator on your phone or on your computer just to kind of run the math yourself to see, but you can take 50,000, multiply it by 8%. Okay. And then divide that by 365. And that's going to give you this daily interest charge of $10.95. Okay. So if your balance stays at $50,000 every single day, you're going to be charged, let's call it $11 of interest based off of this balance. Okay. Now, most people operate in a monthly time frame as far as bills, right? I typically like to view it from a monthly time frame. So what you can do then to figure out what it will be monthly is you take this and you multiply it by 30. Unless it's February, then you do 28, right? But 30 is the typical amount of days in a month. And that's going to give you your monthly cost of interest. Okay. So if you come down here, this is something that I want you to pay attention to. Right down here in the bottom right-hand corner, it shows the impact of a payment. So again, we have day one, $50,000. your monthly charge is going to be $10.95. However, if you were to deposit $10,000 towards this principal balance, this is what's going to happen. Okay. Now your principal balance is going to be 40,000. Okay, so now you're getting interest calculated off of not 50 but 40, and look what it does. It reduces your daily interest to $8.77. Okay, so you can see that you're actually making progress by having money sit in the line of credit. Okay, and this right here over here shows you the savings per day by doing that is $2.18 a day. You know, nothing significant, but it is an improvement. And if you do that on a monthly basis, that's $65.40 per month that you would be saving by putting 10 grand towards the principal balance. And an interesting way to look at this is, right, let's say you annualize that, and you take $10,000, right, you're going to get a 7.8% return on your $10,000 a year by doing that because you're reducing a cost. Okay, so if you take $10,000, right, dump it into a line of credit, reduce the balance by 10,000, it's going to save you this much per day, this much per month. And then if you take $65.40, multiply it by 12, right, that number is the percentage of the money that you're saving, right? So if it's $10,000 and it's, I think I calculated it out to be 780 or whatever, that's 7.8% that you would essentially be making or saving, depending on how you choose to look at it, right? On your money. So we're, we're proponents of not letting money sit in a savings account or a checking account. It's not doing anything for you, especially a checking account. Most checking accounts, if they pay you any interest at all, maybe 0.2%, 0.5% if you're lucky. There are high yield savings accounts where you could get 2-3% maybe, so that would be more beneficial. But me as an example, I never hold money in a checking account ever. All my checking account is just a transfer account. As soon as money hits that checking account, I log into my online banking, whether it's
Well,
on
you
my
don't have to come back
computer
here.
or on my phone.
I'll drive.
I hit transfer, right? And I move that money, all of it, every penny of it, to my HELOC, and it brings my balance down and it reduces my interest cost, just like you see here. So your money is much better off sitting. If you have a balance on any sort of debt and it's a line of credit, it's more beneficial to let that money sit until you need to use it again in that line of credit. A ton of information there. I try to simplify it as much as possible, but this is the math. And that's kind of the takeaway that I'd like you to have from this, is just figuring out how to figure out the math on this. So again, all you have to do is take the balance, multiply it by the rate, divide it by 365. That gives you your daily charge of interest. And then, like I said, I like to look at things monthly. So you take that number, multiply it by 30, boom. There's your total interest payment on whatever debt you have in a line of credit. Now, I use the 8% as an example. My HELOC, I think, is 5.9%, pretty low. So obviously, if you're using this with a credit card, it's going to be much higher. So let's move to this next slide. Hopefully, you guys were able to gather some good information from this without being overwhelmed. Okay, so these are the 3 different types of lines of credit that we're going to go through. So again, we have credit cards, home equity line of credit, and then policy loans. So, the similarities with all 3 of these is that they all use the average daily balance method, which is what we just kind of went through. So whatever balance you have, they all calculate interest the exact same way. Now, as you know, again, credit card interest is very, very high depending on what kind of credit card you have. Most credit cards are somewhere in between this 15 to 25% range or more. I've seen
I'd
some
say
credit
we,
cards
yeah,
north of, 28, even 30%. So
Yep.
that's what we've seen too is 30. It's crazy.
I mean, if you have a credit card balance and you're just paying interest only on it, um, that's tough. It's tough to get ahead by doing that.
Even the cards that are 15% or more, what you might consider benign, are only that until a certain payment period is missed, which is like a month, possibly less,
Mhm.
before it automatically goes to 30%.
Yeah.
Yeah.
So again, you know, if you have a credit card, you want to be aware of all those details. I think most people aren't. So you want to make sure that you understand how to manage it. And again, my opinion, based off of people that I've talked to over the years and things that I've seen and heard, is uh, there's a lot of people, especially these days, with everything being so expensive, inflation. There's a lot of people that have credit cards that are maxed out and they're just paying the interest only on it.
Mhm.
Um, it's tough, but there are ways to consolidate debt that you could utilize. We can help you with that kind of stuff too. But
Mhm.
um, okay, so credit card uses average daily balance method, like we previously went through. Again, super quick and easy to make a transaction. Now, these days, you can just tap your card on the thing at the grocery store or wherever, and boom, the transaction is done. Um, so very easy to use and quick. Some credit cards have potential cash advances, right? So if you do have availability on your line on your credit card, depending on the company, sometimes, say your limit's 10 grand and your balance is 5 and you need 2,000 for something, they'll send you a check for 2,000. So again, could be good, could be bad, depending on what you're using the money for. And again, they do have potential rewards. A couple of people that I used to work with, they use credit cards for all kinds of stuff, and they just let the points build up, and it actually paid for a lot of their trips and flights, right? So it's good for those kind of things too. But again, you got to manage it properly. Some of the key risks, obviously, very high interest rates, high utilization. If you always keep your credit maxed out or more than a certain percentage, typically it's 30%, it's going to hit your credit score. So if you want to get a loan for something and go to a bank, that's going to hinder your um, relationship with the banker, right? And again, it's unsecured debt, so there's a little bit more risk there. Okay, so that's general information on credit cards. Let's move over to a home equity line of credit. So this is going to take a little bit more time, but I'm going to try to simplify this as much as possible. A home equity line of credit is a line of credit that a bank or lender will give you against your home. Okay. So even if you have a mortgage on your home and you owe 300,000, your house is worth 500 as an example, there's $200,000 of equity in your house. You could go to a lender and they might give you a home equity line of credit of $100,000 as an example. Okay. And the way that it works is you have to go to a bank, right? You have to prove to them that you don't need the money. You got to prove that you have good income, provide them W-2s, 1099s, tax returns. They want to look at all your debts, all that stuff. They're going to want to appraise your house, make sure your house isn't in shambles, right? Those kind of things. Once they approve you, they'll typically give you a certain amount based off of what they see, right? So say they give you $100,000 second lien HELOC, you're going to have that available for typically about 10 years. They give you what's called a draw period, which is the time frame that you can move money in and out of the line of credit. Okay. That's typically 10 years. Some banks are 7, some are 15. I've even seen some banks that do 20-year draw periods. Okay. Now, there's two different types of HELOCs. The first type that most people are aware of is what's called a second lien HELOC. That's when you have a first lien mortgage on your house and you go to another bank and they give you what's called a second lien HELOC. So that means that that lender is second in line. So whoever holds the mortgage on the house, right, they're first in line. So if you were to default on your house payments, they get to take the whole house. And then the bank that has the second lien HELOC, they're kind of screwed. So there's a little bit more risk involved with a second lien HELOC. But that's the definition of it. The bank is in second lien position. Okay. Then you have what's called a first lien position HELOC. So if your house is paid off, that's the most commonly known reason to get a first lien HELOC. You would go to a bank and say, hey, my house is paid off. It's probably worth such and such. Will you give me a HELOC on it? They're going to go through the same process, run you through the financial ringer, and then depending on what they see, a lot of banks will give you maybe 80% of what your house is worth. Okay, so if your house is worth such and such, they'll give you a HELOC of 80% of that. So they'll open up a line, same thing, 7, 10, 15, 20-year draw period. You can move money in and out, all that kind of stuff. First lien HELOC is much more secure and safe because you don't have two lenders involved. You just have one lender. Okay. And if you go to a bank and you say, hey, my house is paid off, what do you think the banker sees or feels when you have a paid off house? That shows them that you've had discipline over the years. You've been able to pay your mortgage payments or pay extra and pay your house off. A lot of people can't say that. So banks really like to work with people that have that kind of discipline. Now, that doesn't necessarily mean that you have to have your house paid off to get a first lien HELOC. I'll use my numbers as an example. When I got my first lien HELOC, I owed $300,000 on my house still. My house was worth $450,000. This was 7 years ago. Okay. So even if you have a balance on your house, the bank will still give you a first lien HELOC. So how that process worked is I had a mortgage. I owed $300,000. I went to a separate bank. I said, I want to use a first lien HELOC. Will you pay my mortgage off and then transfer that balance over with you in the form of a first lien HELOC? Yes, they did. So I had no more mortgage. I just had that $300,000 balance now in a big HELOC. Okay. So those are the two separate types of HELOCs. Again, the first lien HELOC, if it makes sense for you, if your numbers make sense, by far that's the most efficient way to utilize the strategy. Okay. So both of them use the average daily balance method like we previously went through, right? Interest is calculated per day based off of the balance. Most HELOCs only require an interest-only payment every month, which can be nice, especially in tight times, right? The interest-only payment is going to be much smaller than your typical mortgage payment, which typically is principal, interest, and an escrow account, which includes your property taxes and homeowners insurance. So, if you come across hard times, right, you're better off being on the hook for a smaller required payment. So most HELOCs are interest only. Some HELOCs are principal and interest, but effectively they work the same way. You'd have to pay a little bit more if it's principal and interest. A lot of banks that offer HELOCs don't have any closing costs, right? Some of them do, but mine, as an example, I paid no closing costs and I don't have an annual fee either. So that's really nice because if you refinance into a mortgage, yeah, you're going to get hit with.
Who's your bank? Who was that bank? I need to know.
What was that?
What bank was that gave you?
I use KeyBank.
Okay.
So KeyBank, they're like Michigan, Ohio, Chicago area, kind of that area. I don't think they're on the west side of the country or down south. I could be wrong, but
New York also.
Are they in New York? Yeah.
Yeah.
So, okay.
Yeah.
Yeah. This is an important one too. So interest may be tax deductible for home improvements. if you have a second lien HELOC, typically the only way you can deduct that interest is if you prove that it was for a home improvement. Okay. However, this is another huge benefit to having a first lien HELOC. And I'm going to say this just to say it. I'm not a tax professional. I'm not giving tax advice. However, I know what I've done for my taxes the last 7 years. And a first position HELOC is considered an acquisition loan. In an acquisition loan, you are able to write off all interest in some circumstances. Mine, yes. Yours, maybe not. Check with a tax professional because I am not one.
Adam, a brief description of
Sure.
acquisition loan?
Yeah. So an acquisition loan is a loan that is being used to acquire a property.
Okay.
Okay. So even if you refinance into something, right, that's considered an acquisition loan. So a mortgage can be one, or a first, basically if there's a lender that's in first lien position and the entire loan on your property is with that lender, that's considered an acquisition loan.
Oh, okay.
Okay. So
Is it a lower rate than a typical HELOC?
it depends. That all depends on your financials. The better your financials are, the better rate that you're going to get, right? So if you have a
Still
high,
variable?
it can be variable or fixed. My interest rate's variable as an example. So when I opened mine up in 2019, my rate was 4.65, and that was prime -1, right? So I got prime -1 because my wife's job, my job at the time, we had, our financials were like tip top shape. So they gave us prime -1. And then interest rates from 2019 to 2022, they went down significantly. So my interest rate went all the way down to 2.4%. So, most people, when they hear variable rate, they're like, oh, my rate's going to go up. Could, but it could also go down. Right. So mine went down from 4.65 to 2.4%. So I was like thrilled because that's super cheap money.
Oh, yeah.
Right? However, in 2022, interest rates spiked up again. So my rate went all the way up to, I think, seven something, low sevens, which was a big difference. So my interest only payment went from like $1,000 to $2,000, So can that happen? Yeah. But now it's back down to 5.9%. So, it can fluctuate. Some HELOCs, you can fix your rate. So you don't have to have a variable rate. That's pretty important to know. If I could go back in time, I did have the option to lock in my 2.4% rate on like a big balance on my house. Obviously, I wish I would have done it now, but hindsight's 2020,
If only
So-
you knew.
Yeah. If only I could go back in time and know how the things have gone in the market and all that stuff, I'd be
Oh,
rich.
I think we would all make changes. Absolutely.
Yeah.
Pretty
Uh,
remarkable rate there, Adam. What caused you, or what, inspired you to not take that?
Well, the way that it works with my bank is if you, let's say at that time I owed 300,000, right? If I wanted to lock that 2.4% rate in, I would have had to lock it in on a specific balance, which means that if I paid it down below that balance, that amount isn't liquid. That
Okay.
makes sense?
Yeah, I gotcha.
So
Good.
that was the primary reason why. But
So then it's just like a regular mortgage.
on that amount, yeah,
And then
Right.
you
Well-
could have got another home equity line of credit from another bank.
could have, yeah.
Well, actually, they're locking
Okay,
in a
sure.
certain return on their contract with you, and if you don't take that, then they're just taking a chance that you're not going to pay it off early otherwise.
Sure. Yeah.
Yeah.
So Adam,
Yeah.
there's a question in chat.
Sure.
So the question is, it sounds like if you would have locked it in, it would have become more of a home equity loan, right? With the fixed rate? Rather than
yes,
a line
correct.
of credit?
Yep.
Great question. Great
Yeah.
question.
So basically how that would have worked, to try to simplify it, let's say I owed 300,000 and I chose to lock in the 2.4% on the 300,000. Okay. So I would be on the hook for paying every month 2.4% on the 300,000. Okay, and I would not, if I paid my HELOC down below that 300,000, say I paid it down to 200,000, I wouldn't have access to that 100,000. I'd only have access to whatever I have above the 300,000, which mine is 414. Does that, hopefully that makes sense. I'm trying to simplify as much as possible, but
There's some give and take, right?
yeah, there is
Either
some give
one.
and take. So, but again, for me, it really doesn't matter. And the big reason why is because I've moved a lot of equity from my HELOC into my insurance policies. So really doesn't make too much of a difference to me. But to finish up on the HELOCs, key risks, there's slight risks to everything that you do. One of these is your home is the collateral. Obviously, with any mortgage, HELOC, whatever, if you don't make your payments, they could take your house. So most important thing, if you have a mortgage or a HELOC, just make sure your payments are being made and you're golden. Nothing's going to happen. And then this variable rates can increase, but they could also decrease. And I've experienced kind of both of those swings. So not a huge deal. And people that are in replace your mortgage or understand that strategy, the more cash flow that you have, which is money above your expenses every month, the less that the rate matters. And that's going to be a kind of a takeaway to this whole meeting is you're going to understand that, interest rates don't matter as much as you think. And we'll kind of keep diving into that. But okay, let's move to policy loans. So a policy loan is I like to, let's say it's like a LELOC or a life insurance line of credit. Technically, it's not categorized that, but it's exactly what it is. It's just like a HELOC, but it's inside your life insurance policy. So let's say you've built up $100,000 of cash value in your life insurance policy. You can use it like a line of credit. You can take a loan against it, have the money go into your bank account. You can put the money back into the policy. Again, it's very similar to a HELOC. However, typically the interest rates they're slightly lower, right, to borrow money with the insurance company than they are with commercial banks with a HELOC. Depending on the insurance company, some of the interest rates are fixed, some of them are variable, just depends. So here's some of the similarities and some of the differences. So again, just like credit cards and HELOCs, the cash value uses average daily balance method, right? So you have a balance, you're being charged a certain interest rate per day. If that balance fluctuates, that's going to either be more interest that you pay or less interest that you pay. So they all three use that same method, okay? As far as payback schedules, right? This is where the life insurance policy differs. Okay, so with a credit card, you have to at least pay the interest only every month. There's no way around that. Same thing with the HELOC. Every month, you have to pay at least the interest. With a policy loan, you don't have to pay the interest every month. Now, you probably still want to, or at least put some money towards the line of credit, but you're not required to. So that can help in tough times, right? Or if you're planning out to do, big money movements for investments, or, you can get pretty creative with this stuff, is you can let a loan ride for 6 months or a year, not even pay the interest on it, and then just dump a big chunk of money towards it, pay it down or pay it off, and you're good to go. So that's a big difference. Now, typically, what we tell our clients is if you have a loan balance, you at least want to pay the interest every year so that it doesn't compound. You don't have to, but you should. So, borrowing against the cash
Really
value.
quick, Adam, can you
Yeah, go
expand
ahead.
why you don't have to? when you say you don't have to pay it back, what does that mean? Just for some of the people that are new to this call.
Yeah. So going back to the HELOC, a HELOC, you have to pay interest every month. It's required by the lender. Okay. With a policy loan, you don't. However, the interest does have to be paid one time per year, and that's on your anniversary date. Now, if you don't pay it out of pocket, what the insurance company will do is they'll just tack it on top of whatever loan balance you have. So that's why you don't technically have to pay it back. But again, you want to, because if you don't, let's say you have a loan of $10,000, you don't pay it down at all throughout the year. Okay. And let's say your interest rate is 5%. Well, if you don't pay the interest, now you're going to be charged interest for the following year off of 10,500, not 10,000. So not a huge deal, but over time, if you keep doing that year after year, that's not a good practice. Hopefully that makes sense. Okay. Well, let me go back here real quick. Key risks. So this is important too. A policy could lapse if your loan exceeds the cash value. We preach this pretty consistently, Shane, don't we?
Mm-hmm.
We're not fans of over leveraging anything really. So if you have a policy and you're always maxing out your policy loan and not paying interest on it, just like with anything, you can't do that. That's not sustainable. So if you don't pay, if you're maxed out on your policy loan and you're not paying premiums, and it's like, your policy is in danger of lapsing. So that's something that you don't want to do. That's kind of what we're here to help you, not get into. So if you're in a tight situation and things have changed and they're not going how you thought they were going to go, please reach out to us. Let us take a look at everything, because there are ways to kind of move money around and do things. That's kind of what we specialize in. But don't over leverage your policy consistently. Can you do it from time to time if you know money's coming in? Yes, I've done that, but it's just not a good mindset or practice to consistently be in, especially with a life insurance policy, because this is an asset. This is going to be one of your strongest performing assets, your most stable asset, the assets that's going to protect your family and provide income for you in retirement. So you want to manage this appropriately.
One more question here, Adam.
Yeah.
That someone put in the chat. So the interest that you pay towards your policy loans, does that go back to the policy holder, or where does that go?
Yeah, that's a good question. We get this question a lot.
Yeah, it's a great question.
So when you take a policy loan, let's say you have $100,000 of cash value and you need $50,000 for whatever, doesn't matter. Okay. There's two ways you can get $50,000. You can withdraw $50,000 out of your policy, which there's no interest on that. There's no taxation on that. However, now you're only earning off of 50,000, not 100,000. So it stunts the growth. So what most people do is they take a policy loan from the insurance company. So the money is not actually coming out of your policy. It's coming from the insurance company. So they're lending you their money. Right?
Well, precisely, that would be that case right there, is that you're taking out a loan against your policy, whereas the policy is collateral.
Correct.
Okay.
Correct.
Exactly. Just like your house is collateral when you get a mortgage or a HELOC.
Yeah, and then instead of taking that money from the policy and reducing the compounding course, you would leave it there, borrow against it. It continues to maintain compounding activity, which increases the value of it. Okay,
Yes.
and then the interest you pay on the loan against the policy, even a portion of that interest still goes back to your policy, right?
Okay. So
Right.
when you borrow money, whenever you borrow money from anybody, there's always going to be an interest cost. So when you borrow money from the insurance company, they're not going to lend you money for free. No one's going to lend you money for free. Okay. So when you pay that interest for that loan, that goes to the insurance company. Now, we own the insurance company. If you
Right.
have a policy with the insurance company, because we only use mutual insurance companies, we own
Mutual
the
is the key
company.
word.
Yeah, it's mutually owned. So the insurance company's duty is to take our premiums and put that money to work so that they can be profitable, so that they can then what? Share those profits with us every year in the form of a dividend. So if you're taking a loan from your own company, if you didn't pay interest, you'd be stealing money, right?
Right.
So you're contributing to the profitability of a company that you own. And it's typically a lower rate than you're going to get from anybody else, right? So
Yeah.
the interest goes to the insurance company. Now, there's a lot of confusion in the infinite banking concept sphere out there where people say, and it's not correct, they say that the interest is coming back to you. There's ways to kind of word that so that it's true and ways to word it so that it's not true. But it's very important to understand that the policy loan interest is going to the insurance company. Now, if you set up a loan repayment schedule and you pay additional interest beyond that, yes, that is going to go back into more premium, which is going to create more growth in your policy. I think that's like a whole other discussion that.
But Adam, isn't it true that even if you don't do it that way, just paying the annual interest that is asked of you, if you pay that annual interest, that still goes towards what you will get in a dividend from the bank, from the insurance bank doing well, right?
Yeah, it's not a one-to-one ratio, but
Right.
yes, you're
But
going
you're
to get
still getting something for it, whereas a HELOC or otherwise, you just get
yes.
something for that. That money is
Yeah.
just leaving you.
I mean, say you're a few years into your policy and your dividend that year is $5,000.
Right.
And say your loan interest that you have is $5,000.
Yeah.
Think
Yeah.
So
like a banker on that.
Right.
I had a question come to me that I couldn't answer because I loaned my friend the infinite banking, the Nielsen Nash book. I loaned it to her.
Mhm.
And she was telling me that some guru that she follows online, she asked the question to them. And she was saying that you have to set up, she goes, hopefully you have it set up so that like when you take a loan out, that your interest, you're earning more than you're paying in interest.
Yeah.
And so she goes, how do you know that? I said, well, the amount of interest you paid, it depends on how much you borrow. If you borrow $50,000, the interest is going to be more. And it
Yes.
depends on how much money you have in your policy. So there is no easy answer to that question.
Well, sorry, Adam.
You go ahead, Shane. Yeah.
One of the things I always like to tell people is if I'm taking a loan against my policy, and I know a few weeks ago I talked about me taking out a loan against my policy for my landscaping, right?
Mhm.
I'm going to be taking out a loan somewhere. If I'm taking out a loan from my bank, how much am I going to be getting back?
Right.
Right.
Right. So that's the wonderful thing about
That's an
these
easy way to
policies.
describe about doing it because I couldn't give her a dollar amount.
Well, and it's because the dividend, you can't calculate dividends. You really
That's right.
can't.
Yeah.
I mean,
I told her that there's a guaranteed amount, which is based on an interest, and then the non-guaranteed amount is your dividend, but you don't know where that is. You're going to earn dividends. Like I'm going to earn more on my dividends because I pay my policy annually versus over a month. So that number just isn't a definitive answer, but that's a great way to say it. Like if you're taking a loan out, how at a bank, then let me say it out loud so I just repeat it properly. You're taking a loan out from your bank and you're paying them interest. How much of that are they going to give you back?
There
Right.
you go. That's
And
that
that's
simple.
zero, and you get some of yours back here.
Yes.
That's perfect.
almost, it really almost is everything. I mean, yes, it's not
Yeah.
one-to-one like Adam said, but once you fully fund your loan back, it's almost as if the value of the cash value had been in there the entire time, those
Yep.
funds that you had borrowed against. So,
Okay.
Yeah.
Shane, another thing, another aspect of this, I think, with you, Deanna, is you can't answer a specific amount for many reasons, really. If I'm not mistaken, you can also take this policy loan, okay, this loan against your policy, and as Shane had mentioned, you can set up a payment plan, but you can also, if you're fortunate enough to be cash flow positive, you can select the interest rate you want in order to have a higher value go in. Isn't that true?
That is, and if you recall, I had that spreadsheet that I showed where, I showed how much it was going to, I was going to be paying back at 5.3%, but I was charging myself 7% because that was the amount, that was the interest rate that the bank was going to charge me to take out that loan. So I thought, well, I want to be an honest banker. Why not charge myself the 7%? So yes, I'm now making the difference between that 5.3 and 7% as well. So
Yeah.
absolutely.
I remember that conversation, but at that time, the whole loan concept was completely over my head.
Yeah.
And now I don't remember, but that's some fancy spreadsheet that you have that you've already that you've created for yourself. So that's a really handy tool. We should get our hands on it.
I love spreadsheets, which you're going to see here in a second.
Yeah.
I'll show you one. But yeah,
Well, let me wrap up with this, and then, and like Shane said, he's going to bring up a spreadsheet, and that's actually going to help kind of this topic that we're talking about right now too. But it's important to know how lines of credit differ from mortgages. Most of you are familiar with mortgages. So with a mortgage, you have a monthly scheduled payment, one time per month. You can make a payment. Sometimes you can make bi-weekly payments if you want. You can set that up. However, any payment goes to interest first, not principal. That's a huge difference from a mortgage to a line of credit. Interest first, then principal. Okay, so your principal balance gets paid down second. They get their interest up front, so it's front loaded with interest. Interest accrues daily until payment date. Extra payments help, but cash held idle until due date earns no benefit. So you're not going to dump in a bunch of extra cash into a mortgage because you can't get it back out. So, and that's another benefit to having a HELOC. So it's revolving credit. You can put money in or out. Okay, you put money in, it reduces what? Not interest first, but principal. So it cuts a principal down first, and then that in turn reduces interest for the next day. So what we advocate is if you have a line of credit balance anywhere, park your cash in the line of credit between paychecks. That's going to minimize your average daily balance and total interest. And there's even more strategic ways as far as timing when you do that. This is a little trick or tip that I'm just going to tickle your ear with. So I pay all my expenses on a credit card. I pay that off at the end of the month. I pay that off from my HELOC. So I take the money from my HELOC, bump that balance up to pay my credit card off. But I always do that on the day before I get paid, because I'm only bringing that balance up for one day, and then boom, my income goes back in the HELOC the next day. So it really helps to, helps the strategy. That's a little tip. So I'm going to stop sharing my screen. And what Shane's going to bring up is a spreadsheet, and it's going to go through a policy loan, and it's going to show how the interest works. And again, the main takeaway from one of the main takeaways is we want you guys to understand that interest rate is not what you need to be focused on. It's the volume of interest that you're paying to someone or the volume of interest that you're earning. Okay, so let's check out Shane's spreadsheet.
I will
and
bring
we'll
it
start
up.
talking through that, and you guys, we'll try to wrap it up soon, and then have some questions. So
Okay, so anybody that go ahead, Deanna. Oh, all right. So anybody that knows me knows that I love numbers. That's how I thrive here. So when Adam said that this is what he was wanting to talk on, we kind of talked about things that would help, and I'm a visual guy. So we decided to create this spreadsheet showing exactly what a loan for $10,000 would look like. if you borrow against your policy. And so I think the majority of you, there's a few that don't, but the majority of you that do have policies have them through Penn Mutual. So I'm using the 5.3% interest rate. Now, Adam did such a great job. He explained how everything is done daily. So anyway, all the information that I have is funneling into this spreadsheet right here, but on this other tab, I actually have broken it down. If I can show you all these hidden, sorry, one sec, these hidden fields right here on hide, you can see that I have everything broken down by day. I'm adding the interest back into there on a daily basis, just to make sure that I'm calculating this correctly. And I'm also stating, just so we all know, that I'm paying the principal on the first of every month. Okay, so it's the first of the month when I'm paying that back. Now let me hide this here and let me kind of explain it. Don't want to confuse you. Can you hide? Okay, so if we started out by taking a loan for $10,000 from our policy, that first month, you know, if I pay, okay, so on that very first day, the day that I take out a loan, and this will probably never happen, but that first day I pay $860.26 towards my loan. Now, that $860 amount, like Adam said, it doesn't go towards interest, it goes towards principal. And you're applying everything towards the principal. But that month, there was $40.30 that was accrued through interest. And so that is added back into the amount. And we wanted to show what it looked like if you were to fund and try to get as close to half of that amount paid off in 6 months. So in 6 months, so at the end of June, you have an ending balance of $5,020.57. I mean, you could change any of these numbers to kind of play with it. But what we wanted to show you is that if you had this policy paid off in 12 months, so in 1 year, now the interest rate through Penn Mutual is 5.3%, correct? Everybody knows that. I see a lot of nods. Yep. Okay. If you paid off this policy in 1 month, in 1 year, like Adam said, you would expect that you're going to be paying back that 5.3% on those funds. So $530, right? On 10,000.
Yeah.
Well, when we calculate it, we're over here and 5.3% of 10,000 is $530. When I add up the entire interest paid, we only paid $237.59, which means if calculated, instead of paying 5.3%, we're only paying 2.32% on those borrowed funds. And the reason is like Adam explained, we're paying down that principal. So when we pay that principal payment, it reduces the total amount, which means less of interest is going to be taken out. Now, if we were only paying the interest on that loan, that's when you would be paying that 5.3%. So $530 for that year. But that's what's wonderful about these policies is they're flexible. You can pay them back at any time if you're having a hard month and you just need, you know, that's okay. Skip it. Let's get back in there. Right.
Yeah,
but
I mean, even look at that first month, right? The interest you would think in that first month would be $53.
Mm-hmm.
It's only $40.30.
Yeah.
So does the interest rate matter as much as most people think? No. It's the velocity of money and the volume of money. That's what matters.
And look how cheap those dollars were. It was only 2.32%. That's not bad.
Pretty good.
Yeah.
Pretty darn good.
Yeah.
Yeah, that's what we wanted to show you is even though and plus on top of that, remember, you're paying that 2.32%, but what's also happening inside of your policy at that same time?
The amount you borrowed against is still accruing its own interest.
It's still accruing its own interest and dividend.
And dividend. That's right. Oh,
it's what we call
really
an asset to where you can
depending
use
on the
same
year
dollar in the same area.
Yeah, depending on the year, right? Your dividend and your growth on your policy might be, I don't know, $5,000, depending on the size of your policy.
Mm-hmm.
So, and the policy amount doesn't change at all. The policy amount stays the same, so you're earning on that,
What do you mean by the policy amount? Yeah.
the policy amount doesn't change when you take a loan. Like my 188 face value or whatever it is, it doesn't change. It's just when I take a loan out, you're still, all the dividends are being generated on that amount, the money that I put in.
Well,
based on
that's a great point. So going back to, do you have to pay off your loan? Well, the insurance company, when you take a loan against your policy, they're never going to ask you, when are you going to pay it back? How are you going to pay it back? What are your terms of paying it back? Because at the end of the day, if you don't pay it back, are they going to be okay?
Yeah.
Well, it
And
comes out of your death benefits, so they already have their payback.
they're on the hook for the death benefit regardless, right? So
Right.
the day that you decide you're going to stop funding your policy, whenever that is, and for everybody, it's going to be a little bit different. But the day you stop funding your policy, if you still have a loan balance, they're going to take and pay off that loan balance through the death benefit. So again, these are the most flexible loans that you could possibly take, but you want to be an honest banker.
Yeah.
You want to have every intention of paying it back, and it's in your best interest to pay it back, because when you calculate it and you show that the dollars coming back in, you're going to be able to pull out more for retirement, or as there was a question in the chat earlier, as you pay it back, you can then recycle those same dollars and borrow against it again using those same dollars. So
Yeah.
So a mortgage and another kind of loans are the interest is front loaded. If you look at it, that this is just in reverse. It's not really that way because they're taking it out of the death benefit, but it's kind of in reverse. If you don't pay that back, they're getting it anyway.
Mm-hmm.
yeah, and so they needed collateral, right? So they're using your death benefit as that collateral. But that when we design these policies, many of you know, we don't design the policy for the death benefit. We're trying, the premium that you're paying is related to that death benefit. The more death benefit there is, the more the premium is going to be. And our total goal is to reduce that premium, which means it's going to reduce the death benefit, because we want the majority of what you put into it to come over here towards the cash value. So that's how we design it. But as we just talked about, there is a reason for the death benefit, because that death benefit is going to be a blessing later on if you ever need to borrow against your policy. So
yeah. So primarily what we wanted you guys to see and understand is how different lines of credit work. A lot of the similarities are there between credit cards, HELOCs, policy loans. The way the interest is calculated is pretty much the same. They each have their, I would say, pros and cons. Some have less cons than others. We view the policies as the superior line of credit. There's no other line of credit that's superior to that. The hard part is you have to fund the policy. So you have to get money into the policy one way or another. Okay, and that's kind of what we help people figure out too. So, does it make sense to pay your house down or pay your house off? It depends. We help you figure that out. Does it make sense to, have money in savings, or in a better place is have that money sitting in a line of credit? Obviously, we kind of went through that. So we kind of help people figure all these things out. And, we're trying to solve short-term problems and long-term problems. So in a lot of cases, paying off debt, using all your excess funds to pay off debt now, is going to help you short term, but it may hinder you long term as far as having money in retirement. So you don't want to pinch yourself by just being laser focused on paying off all your debts. Now, credit card debts, yeah, obviously you don't want to have those rolling year over year, but if you manage debt on an asset that's growing, like your house, and you reposition that money into another asset that is growing that you have access to and provides death benefit and gives you all these other benefits, that's kind of what we're talking about. So we do all these strategies ourselves. I've had a HELOC since 2019, and I've had policies since 2019. I could pay my house off next week if I wanted to, but I don't. Choose not to. So
Do that primarily do the tax advantages?
I don't want to give the bank all my cash value. Why would I want to do that?
Right.
Right? What if I give the bank all my cash value and then for some reason I don't trust commercial banks? You really shouldn't either. What if they close my line out or reduce my line?
Right.
Could happen. It's not going to happen with the insurance company. So
Or what
I
if you
want
had
all-
an emergency come up? Then you can't really easily get the money out
from
for your bank. You paid your mortgage off. You can't get money out of it if it's mortgage. If you put it in your policy, you can pull it out.
yeah, right. So I want to be as liquid as possible. I want to be in the most control as possible. I don't want to be on somebody else's terms. I want to be on my terms. So whenever you work with a commercial bank, they set the terms, right? With the insurance company, I set the terms. Now again, depending on who the person is, depending on who the person is, that could be a good thing or a bad thing.
Yeah.
So you got to be responsible, but I'm sorry, David, I didn't mean
No,
to.
that's all right. That's all right. I didn't mean to cut you off.
I got a question too.
Yeah.
Go ahead.
So I did the policy loan and I don't remember having a choice on raising the interest rate.
So you don't so if you take a policy loan and you want to pay additional interest above what you're paying the insurance company, you do that in your head and you set those payments up on your own.
Okay, that ain't something you do when you do the loan.
No, so say you take a policy loan and say let's use the $10,000 example, and your interest rate is 5.3%. If you want to pay, 7.3%, that additional 2%, you're either going to do two things with that. You're just going to allocate that towards your paid up additions, more premium, or if you're already paid up and you can't do that, then you're just going to add that towards paying the loan down, and it's just going to pay it down faster. And it's going to do what? It's going to reduce that total interest that you pay by more, kind of like what Shane showed.
Gotcha. All right, that was my question.
Yeah, that's a good one.
Actually, I thought you could set that up for a higher rate. Is that something possible, like with Guardian, but not Penn Mutual?
I mean, you can, but it's not like you log in and it says, here, set your interest rate. It's just, you would do it as paid up additions, or you would set up an additional loan payment every month. That's all.
Okay. Yeah.
Which that can be automated.
Because that's what I think that's the crux of the matter, is setting up a mechanism to make certain as a discipline that money is going in.
Yeah. So you can do that. You can set up auto payments for loans or more premium and it'll just automatically come out of your bank account every month.
Right.
Yeah. Any other questions before we wrap this up?
Yeah, that's good.
Yeah. Good. Cool. Well, it's good to have you guys all on here. Hopefully that wasn't too much information. I try to simplify things as much as I can.
It was a very good gradient, I think.
Yeah. But yeah. Don't ever hesitate to reach out to us. We talk to anybody anytime. Some people, are struggling financially, and we like to help those people too, even though we don't get paid for it. But people just need to learn these strategies. There's a lot of different ways to do things that they just don't teach you in school. But you guys have a good weekend. Thanks for coming on. Thanks, Shane, for helping out. And
Yeah, this has been fun.
yeah, this was a good one. Yeah.
I need to speak up more.
Great to see your faces, you guys.
Hey, you guys have a great weekend.
Yeah, you too.
Enjoy that hot weather, whoever's down south.
Right.
Diane's still on there.
I'm in San Diego. It's about 72 today.
Oh, I'm sorry.
Yeah,
72.
Rough.
That is rough. That is
We'll get
rough.
over it. We'll recover over here with the wind that we're going to have this next week.
It's close to 80 here in Tennessee today.
Oh, wow.
I
think I got in Tennessee. That surprises me, actually.
Yeah,
It's
that's pretty good
beautiful
for
today.
this time of year.
I got you all being in Fort Lauderdale.
Ah,
What is it down there, Chris?
It's over 80. It's like about 83, 84.
That's too hot
man.
for me.
A little
All right.
touch of more humidity there too.
Yep.
I
Yeah.
have two heaters blasting me from both directions right now just to keep me warm.
Oh,
It's so
wow.
cold here.
Nice outside, but my office is freezing. They keep it down here. I could have actually a pet penguin over here. All right. Talk to you guys later.
Hey, you all have a great,
Have a good
great
weekend.
weekend.
All
You
See
right,
you
we'll
all.
see ya.
Bye.
Bye-bye.
Bye-bye.
Hey, Carolita, if you have a chance, stay after just a second. I wanted to answer your question.
Hi, Shane.
Hey
Sorry, I
there.
can talk right now.
Okay.
So last week, when we guys were talking about the payments, the different payment methods on your policy,